Lately, you might have heard a lot about tariffs in the news. Right now, US tariffs are making headlines and shaking economies around the world. But what tariffs are, why the US is using them now, how financial markets are reacting, and what these moves could mean for the world economy and for you personally. Let's dive in and make sense of what's happening. Why do countries even trade with each other? Let's say country A is great at growing oranges, but not so good at producing wheat. Country B, on the other hand, grows plenty of wheat, but struggles with oranges. Instead of each country trying to do everything themselves, they trade. Country A sends oranges to country B, and country B sends wheat to country A. Both sides get more of what they need, and everyone benefits. But sometimes, trade creates challenges at home. If imported wheat is much cheaper than local ones in country A, local farmers struggle to compete. To protect them, country A's government might add a tariff, a special tax, on imported goods. Now, foreign wheat is no longer cheaper, giving local farmers a better chance to sell their own crops. So, a tariff is simply a tax that a government puts on goods coming in from other countries. When a tariff is added, the imported product becomes more expensive, which can make local products look more attractive, or at least level the playing field. Countries use tariffs to protect local business, save jobs, or sometimes as leverage in international negotiations, even if it means higher prices for everyone. So it's never just about economics. Politics, power, and even national security are in play. There's a common myth that foreign exporters pay the tariff. In reality, it's usually the local companies and, ultimately, you, the consumer, who foot the bill. Let's say you want to buy a toy that's made in China and costs $10 to import. If the US puts a 25% tariff on toys, you won't buy this for $10. Typically, business may pass that cost on their customers. Let's quickly clear up two important terms: trade surplus and trade deficit. A trade surplus happens when a country sells more to other countries than it buys, bringing in more money. A trade deficit is the opposite. A country buys more from abroad than it sells, so money flows out. But what's happening now? What's the drama going on between the US and other countries? And what do tariffs have to do with it? For years, the US has run a massive trade deficit, importing far more than it exports, especially with countries like China. Some US leaders argue that this weakens American industries, lowers employment, and makes the country dependent on foreign goods. That's a big reason why the US has chosen to impose new tariffs, to try to shrink the deficit, protect local jobs, and pressure trading partners to make fairer deals. In 2024 and 2025, the US has ramped up tariffs against China, Europe, and even some old allies. For example, just this year, the US increased tariffs on Chinese electric vehicles to 100%. Yes, you heard right, 100%. That means if a $30,000 EV was imported from China, it now costs $60,000 before it even hits a US dealer lot. Beyond EVs, US imposed interim tariffs between 54% and 145% on a wide range of Chinese goods, including semiconductors and solar panels. This isn't a one-off move. It's a sweeping strategy. As of August 1st, the US is rolling out new tariffs: 55% on Chinese imports, 30% on goods from the EU and Mexico, 35% on Canadian imports, 26% on Indian products, 50% on Brazilian goods, and many other. In response to that, partners are striking back. The EU is preparing up to 72 billion euros in retaliatory tariffs and delaying commitments until August, while threatening proportional measures if Washington doesn't budge. Canada hit back immediately with 25% tariffs on US goods after Washington slapped duties on steel, autos, and agriculture. Mexico vowed sharp counter tariffs and is deepening trade ties with Canada to reduce US dependency. China responded with matching 34% tariffs, export curbs on rare earths, and blacklisting US firms. But what about the financial world? Each new tariff creates instant volatility. Markets drop, companies rush to adapt, and currencies swing as investors react to the uncertainty. When the U.S. rolled out sweeping Liberation Day tariffs on April 2, 2025, markets reacted violently. The S&P 500 plunged about 5%, the Nasdaq fell nearly 6%, and the Dow dropped almost 4% in the first few days, resulting in nearly $6 trillion global equity value wiped out. Yet remarkably, markets rebounded quickly. As some tariffs were paused and trade talks resumed, indexes erased their losses, and by June, the S&P 500 and Nasdaq hit new highs. Investors were confident that the worst was over, businesses would adapt, and continued AI growth and possible Fed rate cuts would keep the economy strong. This bounce back is nicknamed the takeout trade. Trump always chickens out, because traders bet that despite tough rhetoric, tariffs might be softened through negotiations. Strong job growth, consumer spending resilience, and renewed trade deals with Japan and others supported optimism. But what's really happening around the world as these tariffs go into effect? While some governments hope to shield their industries, the broader reality is that most people and businesses feel the pain. In 2025, new U.S. tariffs are expected to raise consumer prices by 2.3%, costing households nearly $3,800 each, and adding over $1.3 trillion nationwide. Economists warn these tariffs could slow GDP growth by about 1 percentage point and shrink the economy by $160 billion long term. The job market is also at risk, with nearly 600,000 U.S. jobs projected to be lost by year end, especially in industries that depend on exports or face rising costs. It's not just the U.S. Retaliatory tariffs are slamming exporters worldwide. For example, Mexico's tomato industry now faces a 17% export tariff, threatening 500,000 jobs and billions in lost revenue. German automakers like Mercedes and BMW could see more than 10 billion euros in cash flow disappear due to new U.S. auto tariffs. However, some countries are actually gaining. As the U.S. and China trade less with each other, countries like Vietnam, India, and Malaysia are picking up new business, exporting goods that used to come from bigger players. For example, Vietnam's exports to the U.S. have surged over 18% this year as American firms look for alternatives. India is seeing growth in sectors like pharmaceuticals and software, while Malaysia has become a key player in electronics assembly. This trend, called trade diversion, not only boosts these countries' economies, but also helps them attract new foreign investment and jobs. Nevertheless, amid tariff tensions, the U.S. secured several new trade agreements in 2025. With the European Union, a deal capped most U.S. tariffs on EU imports at 15%, in exchange for major European energy purchases and investment in the U.S. Japan reached a similar agreement, ensures the country also receives a 15% tariff cap on sensitive products like chips and pharmaceuticals, in exchange for a $550 billion investment package in the U.S. Talks with India are ongoing, aiming to reduce tariffs and boost trade in areas like agriculture and medical devices. These deals brought some market stability and avoided further escalation, but critics say they mostly favor U.S. interests and may not be long-lasting. At the end of the day, tariffs are about more than headlines. They affect prices at the store, local businesses, and jobs. Companies that rely on foreign parts or export abroad face tough choices: raise prices, cut costs, or even close their doors. Some countries use trade agreements, quotas, or subsidies to help local industries without escalating trade wars, but these solutions aren't always easy or fast. Looking ahead, tariffs are likely to stay, though recent deals with the EU and Japan have eased some tensions and provided businesses with more certainty. Congress is now debating a law to limit presidential power over tariffs, and U.S. courts are reviewing the legality of the most recent tariff hikes. Globally, the EU is preparing new tools to respond quickly to trade pressure. While some relief is possible if barriers stabilize, ongoing uncertainty means higher inflation and slower growth remain risks. companies will have to keep adapting as global trade rules continue to shift. So, do you think tariffs help or hurt in the long run? Let us know your thoughts below. And if you found this breakdown useful, please like this video and subscribe for more real-world economics made simple. Thanks for watching. See you next time.